So I always say if you want to go long Bitcoin, you should not buy the paper, you should buy the real thing, because you're going to further the case of the price going up. And, to be clear, I'm highlighting a risk. This risk is not really that large right now, because we're somewhere around 2 to 4% of the total market cap of Bitcoin in paper, whereas gold is 100%.
Yeah.
So it's still very low. I think that Bitcoin, if it grows quick enough, Bitcoin is barely over $1 trillion.
Yeah.
So if Bitcoin starts to approach USD market cap, and it can do that quickly over the coming decade, then it becomes quite immune from that type of paper attack. It's very, very easy now for Bitcoin to be argued as a credible investment now that you've got these ETFs, you've got BlackRock.
There has been a dramatic change in the narrative surrounding Bitcoin. Bitcoin, which was once written off as a speculative experiment, is now firmly establishing itself as a fundamental component of institutional finance. At the front of this change are visionaries such as Willy Woo, who analyze its ramifications with unmatched clarity. The emergence of Bitcoin exchange-traded funds, ETFs, in 2025 is helping to close the gap between digital assets and conventional finance. Big players like Fidelity and BlackRock are actively changing the market rather than merely experimenting. While BlackRock's more aggressive projections predict allocations as high as 70%, Fidelity's modest 3% allocation may channel trillions into Bitcoin, potentially propelling its value to previously unheard-of heights. According to Willy Woo's research, this economic revolution might result in a 5-fold increase in the value of Bitcoin if even a small portion of the world's assets, which number over $550 trillion, shifted into the cryptocurrency. This is a rethinking of wealth and economic architecture, not merely a market trend. Thank you for watching and enjoy the video.
Where does Bitcoin sit in a 10,000 year view? In this case, it was like 10,000 years into the past, not the future. But we can get to that. And really it was like, if you were to look at the fundamentals of money, we started off with, commodity money. And we basically built this kind of Lindy effect on gold and silver as money, because these things were very hard to get more of, very hard to inflate the supply. And as we moved into the industrial age, there was a change where we tended to trade the paper that was claimable for the gold and silver, because it's a pain in the ass shifting lumps of silver and gold around. So with the development of the industrial age, we started to paperize papers much quicker, and then now we're in a digital age, and what we're seeing is a lot of online banking, a lot of digital payments, but that stuff's not internet native. Really, fundamentally, Bitcoin solved this thing that was thought to be solvable, but it took until the Satoshi white paper in the tail end of 2008 to solve. What he solved was the ability to put scarcity online. Because up till then, I send you a JPEG, you can just copy it to infinity. And so by putting scarcity online, it was the first time we could actually have a real internet native money. And so really the thought is we're in this kind of transition to a fully digital age where so much of our economy is online, and we didn't up to now have a digitally native form of scarcity, a form of money. And that's Bitcoin. And so that's the 10,000 years from the past to where we are now.
Do you think that we get rid of fiat completely with the advent of Bitcoin?
Yeah, this is a really interesting thing when you look at 10,000 years of money, and you find that, we've had first inklings of gold coins and stuff for I think 700 BC. And now we talk about money going from, world reserve currencies changing every 100 years. But you'll find that, they were always tagged to gold or silver until this very, very brief experiment of fiat since 1971, when the gold window was closed. And that's never gone well in the history of the world. So I don't really look at this era of 50 years almost, roughly, as a real zone. You see Weimar Germany went off the gold standard, and it hyperinflated almost immediately. The whole world's on this fiat right now. I think it's a brief experiment. So now the bigger picture is Bitcoin's in the process or attempting to flip gold and silver, like multi-thousand years of Lindy effect, building trust in gold, silver as a form of money. And it's only 15 years into this. We have 15 years of data on it now, and it is going to be quick, and it's not even up for debate. People may want to debate it, but they haven't looked at the data. As of where we are now, it's very reliably 500 million people that have some sort of ownership of Bitcoin in 15 years. And if you run this data forward, we will be 1 billion people having some ownership of Bitcoin by the end of this decade. And by 2035, if this curve continues its path, we're pretty much near majority adoption of Bitcoin as an investment holding. And then the question is this going to be a reserve currency? Will it be money? Will it be a medium of exchange? But it's happening very, very quickly. It's very, very easy now for Bitcoin to be argued as a credible investment now that you've got these ETFs, you've got BlackRock recommending allocations as high as above 70% in some analyst reports. Fidelity, I think, is 3% allocation. You just run that, say 3% of $550 trillion goes into Bitcoin, multiplied by anything from 1 to 5x, depending on where we are in the cycle. You get to some very large numbers very quickly.
Willy Woo describes Bitcoin's revolutionary path as the first internet-native scarcity in the history of money. He highlights the revolutionary significance of Bitcoin as he charts its development from conventional assets like gold and silver to paper money, and finally to digital money. Bitcoin's popularity is growing at an unprecedented rate, with more than 500 million holders as of right now and 1 billion expected by 2030. Institutional giants like Fidelity and BlackRock further strengthen its increasing legitimacy, indicating a change that may reshape international finance and make Bitcoin a widely accepted asset. In addition, Willy Woo examines the complex dynamics of Bitcoin markets, making a distinction between actual Bitcoin ownership and artificial exposure via paper products like as derivatives and futures. The quantity of Bitcoin is permanently limited at 21 million, but synthetic markets intentionally increase exposure above this threshold, limiting price rise by deflecting demand away from the real asset. Here are more clips from Willy Woo's insightful interview to better understand Bitcoin's transformative potential.
Everyone knows there's only 21 million Bitcoins that'll ever be made. But I'm saying that with synthetic exposure, we may have exposure of 42 million Bitcoins available. Quite simply, before futures and options came onto the market, if you wanted to buy a Bitcoin, someone with Bitcoin had to sell it to you. And people didn't want to sell their Bitcoin. And this is very much the case in 2017. Bitcoin rallied from $150 in 2016 to $20,000. And you notice the price went exponential because as people wanted to buy this, price had to rally because the people selling it was so few. So few people had it. Fast forward another 4 years, and the CME now has liquidity. All the exchanges, for the most part, were starting to offer futures, perpetual swaps, derivative instruments. Now suddenly, someone on Wall Street with, this thing's a bubble. I want to short this. You just front your US dollars and say, I'll sell you that exposure. And so effectively, anyone going long didn't have to buy the Bitcoin. They could buy the paper instrument. And now anyone with US dollars could also sell you that Bitcoin exposure. So indirectly, there's only 21 million spot Bitcoin, but the exposure for people who are only interested in the movement of price, they could access the synthetics, and there could be, 100 million synthetic contracts of one Bitcoin equivalent to be bought. When we talk about the spot market and a real Bitcoin, that's secured by energy, and that is a very fair ledger and very hard to corrupt. Once you create a paper market around trading synthetic exposure to it, it creates kind of a dampening effect of how high the price can go. Because if there's a lot of people needing access to Bitcoin exposure, then a lot of people with fiat and you can print infinite fiat can fulfill that. So I always say, if you want to go long Bitcoin, you should not buy the paper, you should buy the real thing, because you're going to further the case of the price going up. And, to be clear, I'm highlighting a risk. This risk is not really that large right now because we're somewhere around 2 to 4% of the total market cap of Bitcoin in paper, whereas gold is 100%.
Yeah.
So it's still very low. I think that Bitcoin, if it grows quick enough, Bitcoin is barely over $1 trillion. The US M2 is 25 trillion, something like that, in the mid-20s.
Yeah.
So if Bitcoin starts to approach USD market cap, and it can do that quickly, over the coming decade, then it becomes quite immune from that type of paper attack.
Willy Woo clarifies a crucial distinction in the Bitcoin markets, the distinction between exposure to genuine Bitcoin and exposure to synthetic Bitcoin generated via futures, options, and other derivative products. Although there is a 21 million coin restriction on Bitcoin, synthetic instruments efficiently increase market exposure over this limit. Woo draws attention to the historical difference, pointing out that prior to the emergence of synthetic markets, the price of Bitcoin skyrocketed because of its scarcity. Derivatives made it possible for Wall Street participants to short Bitcoin or obtain exposure through fiat without really holding the coins. The dangers posed by this paper Bitcoin system are comparable to those that threatened the gold standard, when centralized reserves ultimately resulted in monetary manipulation. Woo stresses the value of purchasing actual Bitcoin rather than paper contracts, though. Possessing physical Bitcoin protects it from possible hazards associated with centralized custody and preserves its decentralized nature, which in turn encourages its price growth. Even while the Bitcoin synthetic market is still tiny in comparison to the gold market, Woo cautions that the vulnerabilities observed in conventional financial institutions may be mirrored by the explosive growth in synthetic exposure. Woo concludes by highlighting the impact of liquidity cycles, explaining how increased money printing has historically fueled Bitcoin rallies, and suggesting that we are entering a phase of growing liquidity and a potential bull market, reinforced by Bitcoin's 4-year halving cycle. And as always, happy investing.